Morning. Hello. Good morning. Welcome to another session of non-entrepreneurship education training. I am Sadiq Murtala Mansur. I'm the one to take over this module, that is financial planning and management. So this is our topic for today. We have the intended learning outcome. By the end of these sessions, participants will be able to have a clear perspective of financial planning and management, learn the process and functions of financial planning and management, sources of finance, cash inflow and cash outflow, cost-benefit analysis paradigms, and sustainable financial planning. So this is what we have at the intended learning outcome. Definitions. What we mean by finance. Finance means a system or study of creating, calculating, and managing money. This entails of what we mean by finance. Financial planning is a comprehensive picture of current finances, financial goals, and any strategies set to achieve those goals. This includes details about your cash flow, savings, debt, investment, insurance, and any other element of financial life. So this is all encompassing. Financial management is about appropriate use of organizational financial resources, such as making investment decisions and employing cash management strategies to maximize profit and cut risks. Do all it is what within your reach in order to cut down the cost so that you can get the materials and all what have you within the minimum, for you the minimum resources so that you can boost your profits. Because without this, or when you are sourcing resources at high cost, you cannot be able to reduce the cost of productions, you cannot be able to reduce the cost, or you cannot be able to even put the competitive price. Because once you are producing a product, you have to be able to know how you can be able to cut down the cost so that you can maximize your profit. Then financial planning management is ongoing process, that is to look at the entire financial situations, because it is continuous and it is ongoing. You cannot just say that this is the end of financial planning, because you have to follow all the bits before you arrive at this, or before you can achieve maximum financial planning strategies, whether it is in short term, medium term, or long term planning. You need to set a sustainable price for your product. You need to know how to cut down the cost of production so that your profit or your product will be at competitive price. What are the components of financial management? This include budgeting, forecasting, investment decisions, managing cash flow. These components are very, very important because you need to make a budget, what it tells you to produce a product or how much it will take you to produce a particular product. Then what are the forecasts, or what do you forecast to see in the future? You need to have this. Then investment decision, you need to know at what point you are going to make a particular decision, or what kind of consequences that your decision have on your product or on your services that you intend to render. Because once you didn't put the right decision, or you didn't make your decision at the right time, you are going to have a lot of issues. Then managing cash flow. Managing cash flow is an ongoing process that you need to know how to manage it very well so that you can be able to reduce the cost of your productions. Then let's see the process of financial management. The processes of financial management are as follows. Number one, determine the current financial situations. You need to know your current status in the market. Well, what kind of weight does your product or does your service have? You need to determine that in relation to what finance does that involve. Then developing financial goals. You need to set your financial goal. What did you want to achieve? And what are the resources did you need to put in place for you to achieve that? Then identifying alternatives of actions. You need to explore, figure out the various goals or the alternative ways that you can be able to follow in order to achieve your desired. Then evaluating alternatives. The alternatives that you have identified, you need to evaluate them. What does that entail for you to achieve this? If you, for instance, put those alternatives as A, B, and C, what other resources does each of these alternative means have? How much it will cost you? What do you need to put in place? This is what your evaluation alternative or what your evaluating method will tell you. Then you can be able to know. You may start with alternative 1, A or B, because this will serve as various options that you have before you. Then creating and implementing financial action plan. You need to have your sustainable, measurable, achievable action plan that you can be able to evaluate to achieve at a particular time. Then re-evaluating and revisiting the plan. You need to re-evaluating and revising the plans, because those will tell you that if you have your various alternative, it's not means to an end. At every period of time, you can be able to pick which one is best or which one is more suitable in relation to your business. Let's see financial statement and analysis. The key financial statement are as follows. Income statement. This is what we call profit and loss statement that will tells you about your profit, asset, and liabilities. Or it tells you about the profit and loss. What kind of resources do you have to start your business? And what will make you to achieve either profit or loss? Because you need to know the cost of production and other costs that you need to attach to your product or to your services before you arrive at this profit and loss. For instance, if you want to produce a particular product, like you want to make a table water, part of the resources or raw materials you require include the polythene bag that you are going to pack your table water in, the amount it will take you to source the other raw materials that were involved in these productions. So the same thing if you want to start a poultry business, you need to know how much it will cost you to buy feeds, the chicks, the vaccines, the cage, the feeder, drinkers, and even the amount that you intend to be paying those that are going to work in that farm. You need to know. So at the end of the particular period of time, you can be able to know whether you realize a profit or you just make a loss. So this is what we have as an income statement. The balance sheet. Balance sheet provides snapshot of company financial state at a particular specific moment, or it is just a snapshot that will tell you that this is your strengths in terms of your assets and liabilities. So this is very important aspect of financial statement and analysis. Then the cash flow statement. This is just a statement that provides tracks of the inflow and outflow, what comes into your business and what goes out of your business within a particular period of time, be it a month, a week, a quarterly or yearly, or at a particular period of time that will determine what you have spent or what you intend to spend in a particular business. These are the ways to build financial discipline, because we must develop a financial discipline if we intend to succeed in what we do. Because without financial discipline, we are not going anywhere. Number one, we need to set a goal. The first thing that we're supposed to start with, we have to set a goal. This is our goal. We intend to make a 1 million naira, for instance, or we intend to spend a 1 million naira. How are you going to achieve that? So, number one, let's have our goal. We set our goal, we put all the mechanisms that we intend to use in order to achieve that. And we have to respect our goal, because otherwise we will not achieve our goal. Number one step at a time. We have said that earlier, that we can explore as much as possible what we can be able to have for us to achieve our stated goals. And we cannot have multiple things at a time. For instance, I have my 1 million naira as I stated earlier. If I want to invest that, I have to start with a single product at a time and ensure that that product is stable and it is sustainable in terms of everything, includes source of the raw materials that we intend to use, and other things that we have to ensure that they are in place for us to achieve that. Then this is number two. Then number three, save your surplus. If you have other means of getting money, we need to have, or we need to develop saving cultures so that we can be able to put some certain amount aside that we are going to make a reference with when we are in need. For instance, a lot of businesses during the COVID-19 were closed down because they didn't have their surplus, or they didn't have alternative means of financing their businesses. Because those that are ready and willing, they have just responded to the contemporary means of marketing their businesses through online and other facilities. For instance, if you don't have sound handset, then you're supposed to use that savings to finance or to get that handset or computer and other things that you required for your online business. Then repurpose your asset or repurpose your asset. This means that you need to prioritize your asset. How did you intend to make your investment, and how did you intend to value a particular asset? What you're supposed to keep aside in order to serve as an alternative that you can call anytime when the need arises. Then last not the least, you need to diversify your business. You have to explore various means to complement what you do and to complement your day-to-day activities so that you can be able to invest your money today for you to have a brighter future ahead. So then let's see our next slide. What do we need why do we need financial planning and management in business? This is very important questions. Why do we need financial planning and management business? Number one, allow you to reach your specific goals without having to compromise your standard. If you have this financial culture or financial discipline, you must by all means defend your set goal. Move along your goal, move along your desire without any compromise, because you have set your target and you have put all the resources that you put in place for you to achieve that. Then it will help you to assess your risk profile and develop appropriate asset allocation strategies. Financial planning is good because with it, we can be able to have our risk profile intact, and we can be able to develop appropriate asset allocation strategy because we can be able to know where, when, at what time do we put our resources in particular area and for particular purpose. Then it also provides directions and meaning of all our financial decisions, leading to more disciplined choice in life. Because once you develop this financial planning or discipline, you can be able to have a guide in your life, in your entire discipline, because you know where to follow, when, at what rate. For instance, seeing your contemporaries buying some kind of assets like buying car or luxury car and spending money anyhow, going to clubs and other activities without making proper right choice. You will not copy them because you have your own purpose. You know where are you going to, or where you are heading to, at what rate and what speed, and what you put in place. It is equally important. It also helps you to plan your investment, retirement, taxes, children's, finance your education, finance your marriage, or acquiring properties that are of greater importance in your life, especially in your future. Because once you know the importance of plan, because this is most difficult things in our life, because most of people do not know the importance of plan. Even if they plan, they never take it as a call to follow that plan because they don't have control, which serve as financial discipline. Because once you have control, you put your plan, you are going to follow your plan step by step. So this will give you important edge in your life and will put you at advantage because you have invest 1,000 naira today, and in the next period or in the next years to come, you may have an asset that worth 1 million or 100 or beyond that, because we know once we have some asset, they are going to depreciate. Their value will go down. And if we have some asset, their value will go off, will continue increase. So with this, you can be able to know there is need for us to have financial discipline in our life and in our business endeavors. So what are our sources of finance? Basically, we have two different sources of finance. We have internal and we have external. Internal is include the amount of money or capital we have invested as an owners. It's include retained profit as we have carried out our business activities or transactions. We may realize some profit. So this profit will serve as part of our internal source of finance. And we have sales of unwanted assets. Those assets that has been depreciated, we can be able to sold down or expose them out. So we can use that money as internal source of finance. Then for external, we have various form of external source of finance. We have debt and equity. Part of the debt, we have short-term and long-term, which include overdraft from bank, commercial bill, factoring, and part of the long-term, we have mortgage, debentures, and unsecured notes. And part of the equity, we may have private and we have public. Public include ordinary shares that we can sell out our shares for the investors to come, like new issue, rights issue, placement, share purchase plan. So these are the part of the sources of finance that we do have. Then cash inflow refers to the money that comes into the business, as well as the money that leaves the business. That's what we have spent at a particular period of time. We have two types of cash flow. We have cash inflow and we have cash outflow. Cash inflow include income from sales, bank loans, investment, sales of spare parts, that we may have some machines that have some spare part. We can sell out those spare parts in order to have money. We may have investment of share capital. We may have investors that have put their money in our business internally as part of the members of the company. And we have personal fund invested. That is our personal income that we feel as we have saved over time, we can be able to put it in our business. And we have some government grant that maybe government will feel that there is need for them to give support to the business owners. So this can be part of the internal or cash inflow that will come into the business. And we have received from factoring and we have our customers. What are types of the cash outflow that money goes out of the business? We have money that we use to buy raw materials, is part of the cash outflow. We have wages that we paid our workers at a particular period of time. We have rent and mortgage. We have interest payment that we are paying our investors. We have payment of wages and salaries. We have payment of suppliers, those that supplied goods and services to our business. And we have interest that we are going to pay bank as loan or overdraft, payment of dividend, payment of loan, payment of leasing or hiring particular or purchase of asset, income tax, VAT, and corporation tax. So these are all part of the money that goes out of the business. We need to have knowledge, understanding of what these two concepts means, because they serve as the yardsticks that we can be able to measure our performance in our businesses. Why it is important to manage cash flow effectively? It ensures liquidity, supports sustainability, because it is important to put in mind that we are doing this business in order to survive, and this business is part of our lives. We have to facilitate growth. It is importance of to manage business, to manage cash flow effectively, because it facilitates our growth. Because with it, we can be able to determine or to understand that our business is thriving, our business is growing. We can be able to reduce the risks through managing our cash flow effectively, because we know where to put some of our resources at a particular time, so that we can be able to signal if there is any kind of problems that we foresee or that will come or that will affect our business, so that we can take right measure at the right time. It enhances credibility as well, because we can be able to have a account of what we do, that we can be able to showcase or to highlight our progress or otherwise. Then we have our next slide that talks about cost-benefit analysis, CVA. This is a systematic process of evaluating the durability of this and cost. We call it cost and benefit because we have to have a balance of what we intend to spend and what are the kind of benefits that we are going to drive, or that our customers are going to make out of what we do, because this serves as a scale that we must balance. CBA is a powerful instrument to account all expenses and even unforeseen ones. We are not only concerned with what amount of money that we are going to spend in a particular project or in a particular business. What we are after is the amount of benefit. Which one is higher? If it's cost or the benefit. If the cost is higher, it's much, but the benefit is less, that we can be able amount of those that are going to benefit from that product is higher, we can be able to pick or make the right decisions. So what are the steps that are involved to make cost and benefit analysis? Number one, identify the project or decisions, identify the cost, how much it will